So now we are going to cover up the basics of Forex trading. So in this section, we are going to talk of most of the terminology that you have to understand. The terminology that you have to know and understand. What does it mean? What is this? What is bearish? What is bullish? You see, that's what we are going to talk about in this section. Right, the Forex market has no central marketplace. It's a decentralized market. So it starts on Sunday 10 p.m. GMT and finishes Friday 10 p.m. GMT. But it does not actually close. Market is open for 24 hours. It is also traded through OTC, over the counter, meaning no central exchange. It's traded directly bank to bank and through electronic networks. So the market opens on Sunday 10 p.m. It starts in Sydney, and in most cases this is called the Australian daybreak. Then we move on to Tokyo session, the Japanese session, Asian session. So the Tokyo Open and the Sydney Open combined, we refer to those as the Asian session. Then we've got the London session. The London session. Then we have the New York session. These two are very important. The London and the New York session. That is where the market trends a lot. But no need to worry about that for now. We are going to be covering all this as we move forward. So now, what is the terminology that is used in Forex? What are the terms that you have to know, the words that you have to know? So here I'm going to cover up the most important words. Remember, there's a lingua that you have to know. We're not going to be talking in layman's terms. Yes, for understanding purpose, we would explain further, but you should know these terms. You should know these words and what do they mean. So there's pips. Pips represents the smallest movement in a price a currency can make. We are going to cover up in detail what is a pip. Then we've got balance and equity. FX equity refers to the absolute value of a Forex trader's account. So here I'm just covering up the basic introduction. You'll see that as we go, I'll be explaining further about each and every term. Then we've got bull and bear market. The terms bull and bear market is used to describe how stock markets or foreign exchange markets are doing in general. That is, whether they are appreciating or depreciating in value. In this case, for a bull market, we'll be saying an asset is appreciating in value. For a bear market, we'll be talking about an asset that's depreciating in value. Then we've got lot sizes. A standard lot is similar to trade size. It is one of the three commonly known lot sizes. The other two are mini lot and micro lot. In most cases, we'll be talking only about a standard lot. Then we've got bid and ask prices. The term bid and ask, also known as bid and offer, refers to a two-way price quotation that indicates the best price at which a security or an asset or a currency pair can be sold and bought at any given point in time. Then we have short and long positions. If an investor has long positions, it means that investor has bought and owns those shares of stocks. By contrast, if the investor has short positions, it means that the investor owes those stocks to someone but does not actually own them. Then we've got what we call stop loss and take profit. Take profit orders are limit orders that are closed when a specified profit level is reached, meaning you are exiting a position in profit. A stop loss order is an order placed with a broker to sell a security when it reaches a certain price point, meaning you are taking a loss on your trade. Then we've got what we call pending orders. A pending order is a request made by a trader to a broker to say at which price level a position should be opened or closed. That is, if you are anticipating a certain asset to appreciate in value, you can place a pending order at a certain price point to say, okay, you must buy this asset when price reaches that point. Then we've got what we call leverage. Leverage is the ability to trade with a large amount of money that you have in your total account margin. This is whereby a broker lends you some of their money to trade. Yes, retail traders, we don't have that much equity. We don't have huge deposits that we are going to make in our accounts. So we use leverage to multiply our equity so that we trade with a huge account. Then we've got margin. The deposit margin required to open or maintain a trade. That is what we call margin. Then we're going to talk about chart types. Reading and understanding a forex chart can be said to be a form of science. This is because they look complicated at a first glance, but once you get used to it, it can be quite easy. Then we're going to cover up the currency types, the currency pair types. We've got what we call majors, we've got minors, and we've got exotics. These are the three types of currency pairs that you have to understand. So now let's take a deeper look into what is a pip. Right. A pip, or a point and ticks, are terms used to describe price changes. A point represents the smallest price change to the left of the decimal point. A point represents the smallest price change to the left of the decimal point, which is this guy. That is what we call a point. To the left. So it's this one here. That is what we call a point. You need to understand this part very well. An investor might describe a stock price increase from $70 to $73 as a 3-point movement. A tick is the smallest price change to the right side of the decimal point. Markets have different tick sizes. It could be 0.1 or 0.01 or even 0.25, as with the S&P 500 E-minis. In that case, a point equals to 4 ticks. So 4 quarters represents a point. A pip usually refers to the 4th decimal place of a price. If, for example, the currency pair Euro USD moves from $12.05 to $12.06, that is a 1 pip movement. However, the term could also be used for any smallest possible price change, regardless of the decimal place, precisely like the tick. The difference being that the pip term is largely used in the Forex market, while the tick is used in the futures market. So you can see clearly from the illustration that I have here. I've got a GBP USD price. GBP USD is a currency pair between British pound against the United States dollar. So 4 represents 0.4 pips. 3 represents 3 pips. 9 represents 90 pips. So it will be like 9, then you get your 00. This is a 0.4, so we've got 90.0 pips. Then 5 represents 500 pips. If you substitute these numbers with the zeros, that means we've got 500 pips. So in most cases you disregard the pipette, which is the 4, the 0.4. That's a pipette. You disregard it when you're counting your pips. Then we've got 2 in black color, which represents 2000 pips. So you see we're counting 1, 2, 3. That's 2000 pips. Then we've got 1, which is our point, becomes 10,000 pips. So that is a visual illustration for you to understand how to count the pips. So here we've got 3 pips, here we've got 90 pips, here we've got 500 pips, here we've got 2000 pips. So that means this will be 93 pips, and this will be 593 pips, and combined with the 2 becomes 2593 pips. I hope you have understood perfectly pips, points, and ticks. In most cases, we are going only to be talking of pips. Ticks are mainly for the futures market, which we are not going to cover up mostly in this course. So we're going to be talking about pips. Now let's talk about balance. The balance represents the outcome of a trader's closed position, be it a profit or a loss. The equity is what the traders would see in the balance if they were to close all their positions at this moment. You are going to see this once I've shown you how to open your demo account. So as long as an investor has ongoing trades, the balance does not represent the actual amount of your funds. Even if they have a significant balance, they could have much less equity if they are open positions with substantial losses. For example, if a trader has deposited $500 and opened a position that's gotten them a loss of $100, they would see the balance of $500, but the equity will be $400 up until you close that position, which is in loss. Bull and bear market. As illustrated by the picture, a bull market is when prices are rising or are expected to rise. Bull markets are associated with investors' expectations that strong results are to continue, or an asset is gonna keep on appreciating in value. So in a bull market, you expect to see prices pushing high. That is in a bull market. When investors are pessimistic and expect prices to decline, it is referred to as a bear market. That means you're expecting price to fall to the downside. You see, you're expecting an asset to lose value. You're expecting price to depreciate. The names are assumed to have originated from the way the animals attack. These two guys here, we've got the bear and we've got the bull. A bull places its head down and points the horns up, while the bear raises its hands and presses the prey down to the ground. That's a representation of a bear market. Now we're going to cover up lot sizes. Now we've got micro lots. These are represented by a 0.01. Then we've got mini lots, which is 0.1. Then we've got a standard lot, which is 1. When investors purchase and sell financial instruments, they generally do so in batches rather than single instances. These batches are called lots. The lot size differs depending on the market and security you are trading. By security, I mean an asset. The common sizes for currency pairs, for examples, are 100,000 for a standard lot size, 10,000 for a mini lot, and 1,000 for a micro lot. But the size could very well differ even for two instruments of the same market. Gold could sell by lots of 2 units, while silver lot would consist of 100 units. Then we've got bid and ask prices. The price at which an asset or a currency pair is sold for is called the bid price. You can see I've put it in color format so that you understand what is a bid and what is an ask price. In this case, $69.58 represents our bid price, which an asset can be sold at. So that is also known as the selling price. The ask price in this case, which is $69.64, represents the buying price. So the ask price is how much one can buy a security or an asset for, or a currency pair. Thus, it is often called the buy price. Sometimes the bid and ask prices are equal, sometimes, but not always. But usually there's a small difference called the spread. The spread, very important. Mostly I refer this to as the cost of doing business. The spread goes to the market maker as compensation for the risk. For a liquid instrument, for example, Euro USD, which is a very liquid instrument, it is easy for the market maker to turn around and buy or sell to someone else. So the spread is small. You are going to realize that Euro USD or most of the liquid markets, their spreads are very low. For less liquid securities, however, the spread has to be more substantial to compensate for the risk of potentially having to carry the instrument for some time, during which the price could go into the wrong direction. So you are going to find out that in most cases, exotic pairs, their spreads, they are substantial, they are quite huge. Now let's talk about short and long positions. When a trader buys a security expecting for price to rise, it's called a long positions, as illustrated by the chart on my left. A long positions, it means you are anticipating the price of an asset or a security to appreciate in value. They will be able to sell it later for a higher price and pocket the difference. For example, an investor who buys 10 shares of Google is said to have gone long 10 shares. But sometimes a trader expects a stock or a currency to depreciate, as in to lose value. Then they would bet against the market and sell the security now to repurchase it later at a lower price. That's called shorting or short selling. You see, because you are anticipating an asset to lose value. And you don't need to own a security to sell it. For example, if a stock is worth $50, right? You've got a stock that is worth $50 and an investor opens a sell position for one share. Once the price goes down to $40, they will profit $10. That's an example of shorting an asset or a stock. So you're going to find out that in most cases, I'll be referring this to as short this asset or long this currency pair as we move further. Now let's talk about stop loss and take profit. A stop loss order closes a position if the security reaches a certain price, which essentially means you're taking a loss. Essentially, it stops losses from mounting up if the price goes in an unfavorable direction. So basically, a stop loss is there to protect you from further losing on a position which is not right. No matter how confident a trader is, it is recommended to set a stop loss order to each position just in case. You must always put a stop loss on every trade that you take. However, even if a position is profitable, an investor might not want to risk the price turning the other way, so they set a take profit. This way, the position will be liquidated upon reaching a certain profit, meaning your trade has been successful. With these options, a trader does not need to continually monitor the charts, as the positions will close automatically when specified. So a stop loss and a take profit is very important, especially when you are now doing your risk management and money management. So now let's talk about pending order. There are 4 types of pending order. There are 4 types of pending orders. Number 1, we've got what we call a buy stop. You are going to see this further once we are on the section of our trading platform, which is going to be MT4 or MT5. This is where you're going to be seeing all these terminology that we are talking about coming into play. So make sure you listen very well, because once we get to that section, I won't be going back and explaining. I'll be basically be saying we've got a buy stop. We are going to set a buy limit in this position. So what is a buy stop? A buy stop is selected when a trader anticipates the current uptrend, which is price appreciating value, to continue rising. Therefore, the entry point is placed above the current price. That is what we call a buy stop. Then we've got what we call a sell stop, which is the opposite of a buy stop. Sell stop, on the other hand, is placed below the price during a continuing downtrend. So that means if you further anticipate an asset to depreciate in value, you can place sell stops so that every time price reaches your sell stop, it triggers a short position. Then we've got what we call a buy limit. With a buy limit, the market is currently declining, but the investor expects it to bounce back. Thus, an entry point is created below the current price. That means you're looking to buy an asset that has been depreciating in value, but now you're expecting it not to keep on losing its value. So you set a buy limit at a certain price point where you expect market to bounce back up. Then we've got sell limit, which is the opposite of buy limit. Sell limit anticipates the uptrend to reverse into a downtrend. Therefore, the trigger price is placed above the price. Now let's talk about leverage and margin. Margin trading, this is whereby leverage and margin, this is whereby you deposit less amount, and leverage will help you in trading as if you've got quite a lot of money. Since the fluctuation in price changes are small, most of the time a common trader will not benefit much by investing solely their own money. So brokers provide a way to open positions for larger amounts than the trader has in the balance. That is called leverage. For example, if an investor has deposited $100 and the broker provides leverage with a ratio of 200 to 1, the investor can open a position for as much as $20,000. The $100 of their own money would be called the margin. It is important to remember that leverage could increase not only the trader's profits but also their losses. So let me give you another example here. Let's say you deposit $500 in your account, and then you choose a leverage of 1:500. How much are you controlling of the broker's money? If your deposit is $500 and you have a leverage of 1:500, so how then do you calculate how much of the broker's money can you control? You multiply the two, 500 times your 1:500. So we've got 25, and then we've got 0, 0, 0, 0. So with a leverage of 1:500 and you place a deposit of 500 in your broker's trading account, you can control as much as $250,000. So what this does, you'll see as we go, this in turn helps you to trade with a bigger lot size. You see, this is gonna help you to trade with a bigger lot size, other than when you're choosing a leverage of 1:1. With a $500 account, you probably might not be able to open a lot size, say of 8 with a 1:1 leverage, but with a leverage of 1:500, you can easily open a position with a lot size of 8 with this leverage. But remember, when you take the losses, it's your money that is deducted. You lose from your $500. So that is leverage and margin. It is a very crucial part of your trading account, the leverage, because that is what is going to determine whether you're going to make it or you're not going to make it. Some traders, they use leverage as high as 1:2,000. Yes, the returns could be massive, but the losses also could be devastating. So now let's look at the chart types. There are several chart types a trader can use for analysis. We will show you the most popular ones, and to make things simpler, all the examples will use the same trading sessions. So we've got what we call a line chart. A line chart has a single line connecting all the closing prices. It doesn't offer much detail, but a line chart is good for observing long-term trends and picking out patterns like head and shoulders and triangle. So chart types, we are going to cover them also in much detail when we are on the section for our platform. Then we've got a bar chart, shows the closing price and the opening price and the highs and the lows of a security. Then we have a candlestick chart, which is the most popular chart. Everyone out there uses candlesticks. Candlestick chart shows the same information as bar chart, except for each candlestick having an enlarged region between the opening and the closing price. It's called the body of a candle, and it makes it easier to spot bar patterns. Then we've got what we call a point and figure chart. A point and a figure chart has a series of X's and O's. Each X represents an increase in the price, and O shows a decline. Whenever the market reverses, a new column is drawn. That's why a trader never sees X or O on the same column. This chart is mostly used for long-term trends like the line chart. So I'm going to show you further examples of these charts once we have reached the section of the platform. Now we've got currency pairs. There are three main currency pair types. We've got majors, we've got minors, and we've got exotics. Major currency pairs consist of the most frequently traded currencies globally. Because they have massive liquidity, you are able to trade them virtually always. Furthermore, you will find the lowest spreads or brokerage cost when trading these pairs. Trade these major pairs only for intra-day trading. That's my advice for you. So I've got a few examples here of major pairs. Number one, Euro USD, also known as FIBA or Euro Dollar. This is the most liquid currency pair in the world. Then we've got British Pound against the US dollar, referred to as CABO. So CABO is the nickname for GBP USD. So this is the British Pound against the US dollar. Then we've got the dollar yen, the US dollar against the Japanese yen. Then we've got USD CHF, dollar Swissy. So these are just a few examples of major currency pairs. Then we've got what we call minor pairs. When a currency pair doesn't include the US dollar, it's called a minor currency pair or a cross currency pair. Most important minors to add to your portfolio include Euro AUD, that's the euro against the Australian dollar. You've got the New Zealand dollar against the Japanese yen. You've got the euro against the pound. You've got the British pound against the Canadian dollar. So these are few examples of minor pairs. What to take note from here is that most of the minor pairs, they don't include a US dollar in the pairing. Then we've got exotic pairs, which is our final currency pair. An exotic currency pair includes a major currency and the currency of a developing economy. You see, an exotic currency pair includes a major currency pair and the currency of an emerging market such as Brazil, South Africa, we've got Argentina, we've got Turkey. You won't find exotic pairs as often as you will find major or minor pairs, which means the spreads, which is the cost of doing business, can be higher when trading exotic pairs. I've got a few examples here of exotic pairs. You've got the euro and Turkish lira. So that's the euro against the Turkish lira. We've got the Japanese yen against the Norwegian krona. You've got the US dollar against the Hong Kong dollar. Then we've got the USD ZAR, the US dollar against the South African rand. So these are a few examples of exotic pairs. These guys are very expensive to trade because their spreads are quite huge. So yeah, that's much about the basics of foreign currency trading. In the next chapter, we are going to look at volume by currency pairs, like which pairs have got the most liquid in the market and which ones you should look to include on your portfolio. So I'm going to see you in the next chapter. Thank you.